Hello everyone. I will cover Chapter 3 in this lecture. Chapter 3 is about Introduction to Risk Management. These are some of the concepts that we will cover in this chapter. We start with the definition of risk management. Risk management is a process to identify loss exposure and select suitable techniques to manage that loss exposure. The loss exposure can be damage by an earthquake or damage due to fire. So what are the objectives of risk management? Risk management has pre-loss objectives as well as post-loss objectives. The pre-loss objective includes preparing for potential losses that may happen and to reduce the financial implications. As a result, there is also less concern and fear, and by doing so, the company is able to comply with legal obligations. The post-loss objective is to ensure that the business survives, it continues operations, and it continues growing. And it also minimizes any detrimental effect on the society. So here I should mention that most of the discussion in this topic is based on business entity. And similar logic also applies for individuals for risk management. So what are the steps in risk management? First is to identify the potential losses, source of loss. Then measure and analyze the loss exposure, that is, measure the impact, the financial impact of that loss. Then select an appropriate technique to manage that loss. And finally, implement and monitor the risk management program, which will take care of the loss. The first step is identifying loss exposure. The sum of the loss exposures for a business would be due to property damage to building or equipment, liability loss, that is legal lawsuit brought by a customer or an employee, foreign loss, that is risk due to doing business in a foreign country, intangible property loss, that is damage to brand or intellectual property. So these are some of the typical sources of loss for a business. So the first step is to identify those losses. Managers who are responsible for risk management in the company are called risk managers. So they try to get information about different sources of loss. They can use questionnaires and checklists. They can do physical inspection. They can analyze the flow charts to find any bottleneck in the business process. They can also look at financial statements to look for red flags and analyze historical loss data. Other sources of information for loss could be industry trends or market changes. That helps to understand any potential source of loss. The second step is to measure and analyze the loss exposure. So there are two items related to loss exposure. So the first is loss frequency, which is how often the loss will occur. And second is loss severity, which is the size of the loss. The risk manager tries to rank loss exposure in order of their importance. So more focus is on loss severity as compared to loss frequency. The maximum possible loss is the worst loss that could happen to the business, and probable maximum loss is the worst loss that is likely to happen to the business. So that gives an idea about the worst case scenario in case loss happens. The next step is to select appropriate techniques to manage the loss exposure. So risk control is the process of reducing the frequency and severity of losses. So there are a couple of commonly used risk control measures. We will look at them in details. The first is avoidance. The company undertakes such action that it is able to avoid any loss exposure. For example, the company may decide not to have any foreign operations. So in that case, the company avoids foreign loss exposure. Then we have loss prevention, which is to reduce the frequency of loss. Right? Loss reduction, which is used to reduce the severity of loss. So I'll give you an example from the transport sector. So the trucking company will ensure that its drivers maintain speed limits as mentioned on the highways. They will train the drivers, they will educate them. That is loss prevention. Also, the trucking company will install devices in their trucks so that the maximum speed is restricted. So this is a measure of loss reduction. You can also think of loss prevention and loss reduction in other scenarios in a business. Then we have duplication. Duplication means keeping backup or duplicate copies. For instance, a company will have backup of its digital data. So in case the computer system is not functioning, then the company can have access to a backup data source and continue business as usual. Separation is ensuring that the items which are exposed to loss are distributed in different places. For example, the company will have manufacturing plants in different locations. In case of a natural calamity, maybe one plant is shut. So the other plants can keep operating and it is business as usual. And then we have diversification. In this case, the loss exposure is spread across different parties. And it reduces the chance of loss as compared to the loss being concentrated in a single source. For example, the company may have liquid cash. The company decides to invest that money and earn returns. So it can invest some money in certificate of deposits, can invest some money in stock market, and it can also invest some money in cryptocurrency. So if one of the investment goes bad, the company still has access to other sources of investment and earn returns. So it has diversified its loss exposure, diversified its exposure to investment risk. Then another technique that is used is risk financing. So in this case, the company provides for funds to pay out in case a loss happens. So what are the methods of risk financing? Is retention, non-insurance transfers, and commercial insurance. So we will look at each in more details. Retention means the company is absorbing part or all of the financial implications of a loss. When is retention useful? When the risk is non-insurable. When the company knows that the worst possible loss is not substantial and it can also predict when the losses are likely to occur. So in these circumstances, retention is suitable. And retention level is the dollar amount of the losses that the company will have to absorb. So these are the retention level is basically the financial implication in case the loss happens. So what are the different ways to pay out? Because the company is absorbing some or all of the losses. So the company can pay out treating the losses as current expenses. The company can also pay out from a dedicated account for the purpose of bookkeeping. The company can pay out from a dedicated reserve fund, or the company can pay out by borrowing from a credit line. So these are the different sources for paying out when loss occurs. So what is captive insurer? Captive insurer is an insurance company or an insurer which is owned by a parent firm. So basically, the captive insurer is a subsidiary of a parent firm. So the captive insurer can be owned by a single parent company, or it can be jointly owned by a couple of parent companies. So if owned by a single parent, it is a single parent captive. If owned by a group of parent companies, it is group captive. So why do companies create captive insurer? The insurance companies may not be ready to provide cover. So basically, the risk is uninsurable. Sometimes the regulatory environment is such that it makes sense to create captive insurers. The cost involved in purchasing insurance from a separate company may be higher. Sometimes the captive insurer may have easier access to a reinsurance company, or the captive insurer has the potential to become a separate business. So these are some of the conditions under which companies create captive insurance. So we must also note that premiums paid to a single parent captive is generally not tax deductible, but there are certain conditions under which the premiums paid becomes tax deductible. In the case of group captive, we notice that premiums paid are generally tax deductible. Self-insurance is another way of retention. So in this case, the company decides to retain part or all of a given loss exposure. And risk retention group is a group captive where it is able to provide certain liability coverage instead of going for commercial insurance. So what are some of the advantages of retention? Maybe the losses are minimal, so paying premium to a insurance company may not be cost effective. Then the associated expenses such as inspection and so on, they may be lower in the case of retention. In case of retention, it may encourage even more loss prevention. And since there are savings on cost and other business expenses, it increases the cash flow of the company. Similarly, there could be disadvantages of retention in some cases. The losses may be higher than what is available through insurance cover. In that case, retention is not profitable. The associated expenses could be higher, and there could also be possible tax liability. So that's all for this chapter. I will continue with the rest of the chapter in a separate lecture. Thank you.